Hi, this is Tim Wegman with BIS Commodities, and let's take a look at the week in review. And let's start out just seeing where we close for the week. We'll start out with December corn. December corn down just a little over 6 cents at 374 and 3/4 for the week. Not down much. Felt like it was down a lot more than that. Beans down just under 12 cents, 11 3/4 in the November contract at 9.45. September wheat. The loser down 15.5 cents, 4.39 in the September contract. August cattle took it on the chin this week, down $5.75 at 109.72 in the August contract. August hogs, which expires on Monday. Monday's the last day for August hogs, closed up 42 cents on the week at 84.65. And October hogs at quite a discount to the front end of the market, closed at 68.62. That was up $1.87 on the week. Taking a look at the grains this week, where we are, we were down a little bit. We're at the bottom end of the charts on the corn. Right now, when you take a look at the December contract, we actually took out some lows. Didn't follow through a lot today after taking those lows out yesterday following the report. Chart wise, it does look negative, but again, sitting down here at these levels, the question is how much more selling could we see come from possible momentum traders and or chart enthusiasts. We're probably going to look for pretty much a stagnant trade, I think, between here and till we have a better handle on what's in the field. Soybeans for the week. Still within the chart range, but we did do a little bit of chart damage with a hard sell-off. Looking to test those lows down around the 9-10 November area is very possible again. Still in a range-bound trade here as well. And the reason for the sell-off here on Thursday was the monthly supply and demand report. And that's where we take a look at yields for the first time this year, incorporate the old crop carryout into the new crop carryout. And all eyes we're going to be on the production aspects. And even though we did get a drop in the corn yield estimate, not nearly as much as the trade had anticipated. We had a 170 plus yield penciled in. The USDA came out with a 169.5 yield. That's about 4 bushels higher than the average trade guess going into the report. It's actually a bushel higher than the largest trade guess going into the report. So with that and no cuts in demand seen on the old crop stocks, we carried all that over. That carryout still came in over 2.2 billion bushels when the trade was looking for something just under 2 billion bushels. Now there's a lot of anguish in the farming community is how the USDA did cut them down only as much as it did. The trade was thinking maybe a 166 yield, and maybe that's where we're at. The USDA does not usually takes their conservative approach on either up or down on things of this nature. But a lot of question is going to be taking a look at how it was come up to be this number, and everybody's pointing towards the year weights. Yet to be determined if next month, if year weights are lighter, it'll show up in that report. Taking a look at soybeans, but the surprise there is we actually increased bushels per acre 1.5 bushels at 49.5. That's up from 48 last month, and that is almost 2 bushels higher than the average trade guesstimate. So even though we did cut old crop carryout stocks due to increased exports, the large amount of acres and the higher than expected yield did balloon that carryout number up much higher than anticipated, up there to 475 million bushels. Thus, we've seen the 30-cent sell-off in the contract. The discrepancy there is we were looking at crop ratings at out of the last 10 years. We were looking at the second lowest, only the 2012. So the concern is there, why is there a widespread discrepancy between the crop ratings and this number put out by the WASDE? So these are baseline numbers, and these are the numbers we'll have to go on moving forward. Taking a look at the weather from this point forward, there are some rains around the grain belt. Iowa looks like it's going to be excluded for the most parts, and there is hints of heat coming back into the Midwest in the 6 to 10 day forecast. 90s, maybe even hundreds coming into the western plains, western Iowa and Nebraska as we approach next weekend. Something to keep an eye on. We'll see if we get some rains to help ease some of the guys that unfortunately have been missing out at this point. Taking a look at what the money did, the managed money, we did see that they did back off some of their longs on the commitment to traders report. Granted, that is 4 days old as we're looking at it today, 3 days old, and still long around 67,000 contracts of corn still. We're obviously lowering that at this point in time. Beans, the commitment to traders report showed us that we were down to maybe just only long about 13,000 contracts. I'm sure we're probably short beans right now. And again, I think we're going to probably take a look at continued weather, and we're going to continue to debate this yield estimate for the next 2 weeks. And I think that's probably going to create a choppy trade for the most part next week. We'll see what crop condition ratings come out and say Monday night. Taking a look at the livestock markets, cattle, very ugly week. Started off with a weaker cash trade early on Monday, a light cash trade weaker, and that seemed to just kind of spark things off. We've seen some follow-through weak cash trade as the week moved on. We've seen boxes grind lower, just continue to feel that pressure, and futures just following everything lower at this point. So it still looks like a very good basis play for hedgers out here, with cash still trading to the premium to the future. So maybe we've seen some hedgers taking the opportunity in here to capture some of this basis as well. We did see the boxes close under $200 in the choice today, under 200 in the select as well. That spread's a little over $3.50 apart right now. Another thing is on the commitment of traders report, felt as if we did see some liquidation by the managed money. It felt as if the index funds were trying to get out of some of their long positions in here and been hitting this market frequently over the past a week to 10 days or so. We did see a nice bounce back today. You can argue that there's some chart support down around that 106.50 area, and the October contract, I think that's probably an area that we need to hold here moving forward. Early talk next week is for some weaker cash continue to follow through. We'll see. Hogs, very quiet week in the hog futures this week after we've seen the very strong move from last Friday and the follow through from a strong move up today in the October contract, that is, and then as a very quiet sideways trade the balance of the week. August does go off. The cash index is really holding its value well. It looks as if the August contract is going to go up and meet that cash index upon expiration. The cutout for the most part this week held. We ground lower there, cash ground choppy sideways more or less. We did see bacon make new highs early in the week, only to ease back off as well. You take a look at these deferred hog contracts. Now we know we got very large production numbers coming into play. Right now it does feel like if we do break out to the upside on this thing, it'd be an excellent hedging opportunity for the perceived numbers coming as far as production is concerned. But again, I think it's going to be very important for these levels to hold for the October contract. I'm certainly wanting to protect these levels. If you have any questions about these or any other markets, feel free to give us a call here at BIS Commodities at 1-800-373-2525.